Major support for these broadcasts is provided by the CUNY TV Foundation, New York Community Bank, Kilroy Architectural Windows, New York's window company, Capital One Bank, Perfect Building Maintenance, Chase Commercial Term Lending, Geneva Burns, Gian Tomasi and Webster, M&T Bank, the Wickoff Group, Chelsea Lighting, Greenberg Traurig, LLP. Additional support is provided by Ackman Ziff Real Estate, AKA Hotels, Corman Communities, Bank of America, Merrill Lynch, Bank Leumi, USA, Briarwood Organization, CBRE, Colliers International, NYC, Cushman & Wakefield, DDG, Douglaston Development, Levine Builders, Dime Savings Bank of Williamsburg, Eastern Union Funding, Flushing Bank, Friedman LLP, Herrick Feinstein LLP, Hersha Hospitality Trust, Investors Bank, New Banks, James D. Kuhn Real Estate Center at Syracuse University, James Orphanides, Centurion Holdings, John Katzimatidis, Red Apple Group, Margolin Weiner and Evans, Madison Realty Capital, Meridian Capital Group, Newmark Grubb Knight Frank, People's United Bank, Popular Community Bank, SJP Properties, Sterling & Sterling, Stonehenge Partners, Urban American, and these friends.
So here we are in the summer of 2013, and everybody wants to be in New York City, and everyone is building, and there's development, and, I don't know, it seems that we're really in a good time. But as my friend Mr. Adams will say, he knows I'm a pessimist at heart. So as opposed to being the pessimist at heart, I brought together people who are optimistic, plus a banker, so I'm not sure how optimistic he is. But hopefully we'll all get an idea of what's happening about development in the residential market in New York City. My guests, they include Martin Nussbaum, who's the principal at Silverstone Property, Barry Radofsky, who's the managing member of Bronstein Properties, Ben Shaul, who's the principal at Magnum Realty, and last but not least, the banker, the guy who has the money, the guy who gives it out to some of these people over here. My good friend John Adams, who's the first senior vice president of originations with New York Community Bank. So you came a little late to the taping because you were providing and agreeing to put out money.
That's right.
So how's the bank look today at the world of financing?
Well, we're still very bullish on the residential market here in Manhattan especially, and the Outer Boroughs.
You better say that. You do business with him.
The Outer Boroughs, we love the Outer Boroughs.
Okay.
They're a large part of our portfolio, and without them, we wouldn't still be as successful as we are today. We're still very confident. Anytime anyone is putting anything up by way of new construction, I'm amazed, and other bankers are amazed at the absorption rate that these units are being leased up. Literally, as soon as you put the sign up, people are ringing the phones, and leasing activity is very robust. Our sweet spot is still the rent-regulated properties throughout the boroughs. I mean, there we get most bang for our buck, and we get to revisit the loans on a more frequent basis than on some of these newer construction market rent buildings. But we're very confident that we're in a very still strong, good residential market.
And since you and I and Mr. Radofsky over here are closer in age, you're comfortable with that market also, right? You haven't really built new developments.
We're not developers at all. We haven't done any of that.
That's why I put them over here.
Right.
Yeah.
I assume it has to be a young man's game, Michael, to do development. We buy mostly multifamily. Our base was Queens. We've expanded out from there. Almost all of it is rent regulated. Our original, as I said, was Queens. We bought Brooklyn. We've focused a little bit more on core Manhattan in the last couple of years.
You bring up something about rent regulated. As we've said, we've had 12 good years with Mayor Bloomberg, which has helped our economy even during a recession over there. That may have a
Well, I think you're right. I think I didn't want to start out on the down note, but look, our renting is going very well. The demand is up. Our effective vacancy rate is really way below 2%. The only apartments we have vacant are the ones that that are being renovated or cleaned up. It's really transitional. Everything we have gets absorbed, just about. We're getting. I was here last year and I said the rents were up probably 6 to 10% over the year before, and I can say that again. The market rents are up. We are doing very well. The downside to this is two things. One is that our taxes, when I used to model buildings, our taxes were 18% roughly. That was the rule of thumb of
Now we're
rent roll.
close to 30.
We're at 30. It takes a big chunk out of your net income. Water and sewer used to be almost a throwaway. Now I model 700 and sometimes 1,000, depending on where the building is, per unit.
So, when you say that, I have two guys over here who own property but are also developing today. How hard is it to be a developer?
Development is tricky today. Land prices are much higher than they were last year or the year before that. Development is a different game. The execution of development is very, very important. I still feel as if there's a lot of opportunity in development today, so long as you can execute the business plan properly and buy land at the appropriate levels.
What is the appropriate level, Mr. Nussbaum?
I think land prices over the last 18 months have spiked. And for me, when I'm looking at land right now, I'm a little bit hesitant in New York City, real New York City, because land prices at this point, for me, aren't able to sort of underwrite on a rental basis. Whereas 18 months ago, maybe 24 months ago, even in New York, you could still look at land and potentially work it as a rental. That's why I spend most of my time sort of buying in Brooklyn, where I still think you can comfortably underwrite rentals. There's still an opportunity to buy certificates, which help from a tax. We were talking about taxes. Taxes are unbelievably expensive right now.
But aren't certificates, for my viewers, a certificate is a means of a tax abatement. It's a 10-year tax abatement, a 12-year tax abatement, but eventually you have to pay the piper, but there's a tax abatement. And to get those certificates, you have to pay someone who has created the certificate, so you have to pay it. It's in the cost of operation. But how does somebody, Brooklyn, the discrepancy, the change in the rents, aren't that different today in Brooklyn and Manhattan. So, and your operating expenses, as Barry said, are still operating over there. Who's buying in these new developments? 10 to 12 years comes very quick. And then, you got to pay full taxes. It's an operating, big difference.
What we're seeing, especially on the newer construction, and we don't do a lot of it only because we do sensitize expenses, a lower interest rate environment, we do sensitize at a little bit higher rate. So we typically don't hit the number that someone might be looking for in a newer building.
Are you talking about development or newer?
I'm talking about newer completion, okay. Recently completed new right. CO. A lot of foreign money. There's a lot of foreign money, people coming in who want to buy. I'm talking about a straight apartment building. It's, you've seen a lot of Canadian money. There's a lot of pension fund money out there where they're happy with a 4 or 5% return. Whereas, and
they're also coming with a lot of equity.
A lot of equity.
So a lot of these buyers on some of the buildings that we sell that are new construction, that again, I think the banks are sort of very difficult to deal with from a certain perspective because they are valuing in this transitional phase of the real estate taxes going up. There's a lot of equity coming into these deals. It's not a 20-25% equity, check. It's
but I believe
35 to 40.
I believe prior to the show, a comment came out that there are certain banks, not New York Community Bank, there are players out there who are not as astute to the world of the tax abatement or the valuation, and they're looking at it with half of an eye as opposed to 2 eyes, and not understanding that tax abatements burn off.
And a lot of these banks, sorry to jump in, a lot of these banks, though, came out of the, after the bubble burst. So they really haven't been stung. We've been around a long time. We've lived through many, many cycles. So we factor that in our underwriting, the what ifs. You're not seeing the what ifs coming out of some
But
of these other
here's
cowboy
another
banks.
question. You know, I was talking on a show a couple weeks ago, and we were talking about five-star hotels, and we were talking about developments, and we were talking about Starwood Capital, who's a REIT, and they charge a very high number to do a deal. And as I think Ben brought up in the green room, you know, I can't live with a 9% Starwood. But people are paying this, okay? You know,
that's because
you
people.
know, JDS Stern, you know, he's
Some people have a different view in the market and are building condominiums that are very high end, and they feel that they can absorb much higher leverage with much higher rates. And if they're very successful in their business plan and they can execute perfectly, then they'll be fine. And if the market continues to grow.
My question is, what do you see as developers, as owners and bankers, as the best asset class? Is it the best to build and sell the condominiums and let the buyer beware? Is it the best to own like you've owned? You own 6,500 units and you manage another 2,000 in that manner, and hey, let me make a couple of dollars and I'm not greedy? Is it the best to convert to you know, I'm just,
I think
you
it
know.
depends on your business model.
In our opinion, in our business model, we own assets long term in the family that we will keep forever, never ever sell, and we have a lot of large institutional partners where we develop assets. Either it's multifamily value add or new construction rental, and we know that with those partners there's an exit eventually.
But when you have a private equity fund, since I work for them, there's a cycle. They got to get rid of.
Of course.
Okay, there's a certain time.
But what I'm saying really is that, like the stock market, there are different disciplines to invest in. And for us, we look at our business in real estate like it's the market. You could invest in bonds and equities, in options. For us, it's the same thing with real estate. We have our core business that we continue to buy for our family. We have development deals, we have condominium deals, we have retail deals. And if we continue down this path and we diversify our business, we feel that if the world moves around a little bit, we can balance it out.
Right. So it's like as they would say in the Wall Street, going to an investment advisor, you have a balanced portfolio of bonds and stocks and variety of things. So you're trying to put your eggs into different baskets that you're over there.
The only difference today versus before, versus pre-bubble, is pre-bubble we took on a lot of leverage. Now it's post-bubble. John is one of my lenders, and he'll tell you that we do not take on a lot of leverage. We prefer to have a lower interest rate on our construction loans and our multifamily, and have lower leverage, and we're very comfortable with that.
Here's something that, not with you or Martin, but I'm seeing, because I'm seeing people who are out there saying, you know, hey, you know, it's a great time to be a developer, which you remember pre-bubble. Pre-bubble, everybody wanted to be a developer. Then the world ended for a couple of those pre-developers. And now, again, since the world is happy and people are buying condominium units, you know, during the recession, people had to see a final unit. Now, give me the floor plan. Forget this. I don't have to worry about that. I'll go in there. I'll sell 60% of the units. And then there are people out there, they say, hey, you know, I'm as smart as Martin or Ben. You know, I could be this. Hey, they're only a couple of years older than me. So a 31-year-old kid or something, 28, says, I'm going to build in Williamsburg. I'm going to go to Ditmas Park. And then they go to you, and NYCB says, hey, I've learned, I've seen this too many cycles. But there are people who believe it's easy to be a developer, and I think that's a totally incorrect feeling.
Michael, I have to admit I'm a little jealous of the developers. I mean, it's very sexy. What we do is a little bit more plain Jane, and we would love to do it, but frankly, it's a very different business, and we just don't have the skill set. We're not developers. We're very good at what we do, but it's running existing properties. It's different.
Now, do you want to? Okay, development. You know, as I allude, is a developer is like a junkie. A developer has to do it's nothing negative. You know, you're a developer. You have to do a next deal. It's a next deal. It's a next deal. It's a different market. When you're in a Barry situation or a conservative as a banker, you know, we're in a different market. Do you want to also, do you think there's a time to own apartments? Like as I said earlier, my friend Ophir Denny, he loves owning apartments. You know, I had one condo, I never do another condo. I learned from that. You know, it's a different market. Certain people said, hey, Lenny Litwin, you know, you can't knock him. He's 98 years of age. He hasn't done a condo, but he's doing a new condo now. He's doing one this year.
Well, the thing with condos too, if you don't sell it all out, to say sell out half the building, then you're dealing with 50% of your ownership is, well, ownership of the entire property. You're dealing with a whole bunch of other people. You don't have full control. You know, you have boards, there's voting, and you could be voted down if you don't have a majority of the voting interest. So that's, as far as we're concerned as a bank, fractured condos, you know, where they're not totally sold out, we'd rather not. There's some good opportunity out there, but having control of the whole property, you know, with one borrower seems to
You
work
know,
best.
since we're post-recession, one of the biggest problems that a number of my guests have told me in the past is getting end loans. How's the world today on end loans for condominiums?
We see very, very low leverage. We looked for an end loan on a condominium that we completed in December just because we knew we had enough sales in place and we wanted to pull some cash out. Fortunately, we sold out the building very quickly, but the financing market was very light. It was 30 to 40% leverage. If you wanted to go with conventional rate financing, if you wanted to go with more high-octane financing, higher leverage, it was very expensive and it wasn't worth it for us.
I agree 100%. I mean, I think right now, I think it is becoming more available. I mean, we were talking before that clearly the financing market is opening up in all different aspects. And I think you were talking before about sort of inexperienced type of developers. And I think that the financing world has allowed them to sort of go out there and say they want to do business, because I would bet a year and a half ago there would be no chance for them to get a loan. Whereas today, I think there are banks out there that they need to put out money like everyone does, and they're taking a little bit more risk than they're used to taking, and that gives opportunity to developers, which I think is a good thing. I don't necessarily think it's a terrible thing, but it does give people an opportunity to do
But in the same
work.
manner, you know, I'd like to hear, as developers and owners, Barry, I believe you're seeing many more opportunities from lenders, because there are a lot of new players in town who, you know, who offices have to go there.
Sure.
You know, BBVA just came into market for Fifth and Third came into the market, you know, Customers Bank, all these people. And if they come into the market, they want to open up a loan production office. You know, Bank United's here, you know, Candace is back, you know, all the rest.
Yeah, but Michael, I think, look, we're really benefiting from this low interest environment. We're doing a lot of deals at 3% 5-year money. We're even doing some deals under 3% for 5-year money right now. So the interest rates are great. I think, though, I have to give the bankers credit. For the most part, they've been fairly conservative on loan to values. We're not, you know, we're still doing 75% LTV, maybe 80 in certain deals, but
As an experienced owner, how long of a loan do you want today? Do you want, you know, you're one, then we take a younger point of view. What do you?
So our basic model is we buy a building, let's say for $4 million. We put $1 million into it. We borrow $3 million from John, who's been a great lender for us, and we work it for 4 or 5 years. We raise those rents, and we borrow $5 million at the end.
But so you're taking a 5-year.
But what about
loan
that?
5 to
situation.
7, I think.
5
What
to
about
7.
on your repositioned assets where you're done repositioning the building? Are you still taking
We're
5 years?
never done. You know, with the way rent regulation works, your rents are always, I mean, there's times when your rents get up to market, but basically you're always at a situation where your rents are under market and you work them and you raise your rent roll at a level above inflation almost every year.
It's the lender's favorite product is a shorter term, especially with Barry's model. That's been our success.
But when you're doing a loan, we were talking on a show a couple of weeks ago, are you doing a debt yield at the end? Are you looking at an 8 or a 9% debt yield at the end?
Debt yield is the new debt service coverage. You know, you never heard about it before. Now everyone's talking debt yield. You know, you need to have a 9 or a 10, and we still look at straight coverage. I mean, we're old school.
You still have the quill.
Yeah, we still
And
have
the
the,
app-
that's right. That's right. I still dip before I sign. We look at coverage, and you know, you could have a 75% loan, but is that 75% loan because you have an artificially low cap rate? If you raised it 100 bips, is it then, you know, is that really then an 80% loan? And vice versa? Coverage doesn't change.
And you, the two of you, how do you like? You like short-term lending, or like Barry, 5-7 years, you know, make them happy?
I think it depends on the asset and who the partner is and what the ultimate plan for the asset is. Again, if it's in our family, we're looking more for 7-year money. We just did a few new loans with John. Everything is 7-year. We pay the higher freight on the rate, and we're happy to do that. And we kind of want to put it away and not worry about it and keep the leverage low. If it's something, I have a loan right now with John where I'm completing a construction conversion of a nursing home. And on that asset, we're going to look to sell the asset in a year or two.
So it's a different market.
It's a different market, and we're looking more for LIBOR-based financing of some sort, something that's assumable, something that's very attractive to the institutions who buy this caliber asset.
Now, who's buying? Who are you selling these properties to that you're developing? Who do you know? You were alluding before that you're seeing Canadians, you're seeing foreign investors. Who are the purchasers today?
I'm seeing a lot of, there's a lot of REITs, there's a lot of insurance companies, pension funds. I mean, I think they're all chasing after the yield, albeit small for us from my perspective, but nonetheless a yield that's safe. And
I think, you know, when you talk about insurance companies, you take TIAA-CREF. TIAA-CREF has been buying so much in the multifamily at low yields. I mean, they bought the corner on 72nd Street. They bought some properties from, you know, Gary Barnett and others. So I believe the REITs are out there and so on.
EQR is also very active.
Right.
And I think they're all sort of trying to go after the yield, and there's inflationary hedge. I mean, there's all the reasons that make sense. The question is, are these artificially inflated prices based off of the interest rates?
What about capital gains? What effect do you see that having an effect on the real estate market as a developer, owner in general, the three of you, and also as a banker? Ben?
I haven't really thought about it too much.
No, because certain people,
Listen,
you know, they look at...
it's obviously of a concern to everybody, capital gains.
See, but when you do condo, there's no capital gains. It's ordinary income.
But listen, as long as it stays there, as long as we stay away from having any gains and we're able to stay sheltered, I think everything is great. I think if it goes away, we have a major problem.
Harry?
I was going to say the only effect I really saw was that at the end of last year, when everyone was really uncertain about what was going to happen, there were a lot of transactions.
We had $41 million in transactions. You know, the biggest sales volume in a quarter in about 10 years because of that.
And Michael, what was interesting about those deals, at least the ones that I saw, is that I figured if somebody came to you in early December and said they had to close by the end of the year, that you would get some kind of discount, and I didn't see it. So we didn't do any year-end deals like that.
But you know, as an owner of 6,500 units, you must get people calling you all the time, all these brokers. Barry, come on, sell the property, sell some properties.
We do, yeah. Typically, we're not sellers. We've sold properties strategically, but we use if you can take the property, get all your money out after 5 or 7 years, and still own the property, it's a pretty good business.
It's tax-free money.
And it's tax-free.
As someone would say to me, you know, I don't have my crystal ball. Sometimes you have the apples near you, so I can't snuggle up with the apple. Where is the greatest opportunity in the future? Is it the Bronx? Is it Brooklyn? Is it Queens? Or as somebody said to me, Staten Island's non-existent. But where is the opportunity?
There's opportunity everywhere. There's always opportunity, just a matter of finding it. Same thing, there's always opportunity in rentals or...
I'm talking location-wise. I'm talking where, you know, I don't believe there are opportunities out in New Jersey for certain business. I think New Jersey market and Westchester market has not done well, and it's not doing well. The office market has been terrible. The warehouse market, you know, is okay, but the rents in New Jersey and Westchester haven't increased in 20 years.
Flat.
We can talk about Nassau County. The real estate taxes could kill you over there, so it's not really a market. So if somebody was looking and saying, where is a good opportunity as a banker, where would you also
I'll tell you where we're seeing, out of New York, but not New Jersey, not Connecticut. I mean, we're seeing markets such back, Florida is coming back because there was such an exodus or a downturn in rents. Now they've stabilized and they're being underwritten at more realistic levels. We do some lending in Arizona. That market has really done very nicely rebounding.
And Cleveland?
And even in, well, Ohio, I mean, listen, I love our friends in Cleveland and Ohio, but I haven't seen the resilience or the bounce back that I have seen in Florida and in Arizona.
And what about you?
I said the last time I was on your show, I said the same thing, and I still actually believe it. I think that Brooklyn clearly is a market that's exploding and just keeps pushing further and further out. And then, you know, Western Harlem.
So are you ready to go to Coney Island?
Close enough, close enough. And I also really
I think convenience is the, you know, Coney Island, if it had better transportation, it has reasonable transportation, but Coney Island is still an hour away. And, you know, transit developments need quicker access. And the negative of the property, which is Great Waterside on the cyclone site, is it's an hour. You know, it's an hour. It's an hour to downtown Brooklyn. It's an hour to Manhattan, and people don't want to be in the train that long.
So we have some properties in Gravesend and Bensonhurst, and they're great markets, but they're really, I consider them sub-markets. You don't get the kind of rents and the kind of volume that you do in neighborhoods like Ditman
Great
Park.
community.
Yeah, absolutely.
Okay, and
But
the rents will be there, but they're not going to increase.
So,
you know?
so what we've tried to do over the last couple of years, actually for the last 20 years, is we always try to find that we always try to be one neighborhood ahead. Like once the cat's out of the bag, we don't want to be there because we feel it's overpriced. So I'm giving away all my secrets here, but the neighborhoods we really love now, Ditmas Park in
Kensington.
Brooklyn. Kensington's a great
It's
neighborhood.
expensive already.
They're starting to get a little pricey, but those.
Bushwick?
Well, Bushwick's already done. As
Yeah,
far as I'm
Bushwick, very
concerned,
surprised
what's
with
interesting about Bushwick is now they're talking about Ridgewood. So it's like it's already pushed through Bushwick.
What about, you know, Brownsville? Not yet.
I don't think it's there yet.
Ben? It's not for you. Okay. I mean, and in Queens? Sunnyside?
Sunnyside is
Sunnyside's hot.
terrific
Long Island
neighborhood.
City Astoria is hot. But you know, what's next? You know, you're seeing, like Barry said, I think you're going to see Ridgewood. I think you're going to see Glendale because you do have transportation there.
But what about City Island in the Bronx? Which I think is interesting, but I think the negative problem is like Gravesend and Coney Island.
It's getting there.
It's getting there. You got to take a train and you got to take a bus. It's like it's like the Rockaways.
Transportation is key.
One of the other areas we love is the Seaman Avenue corridor in Upper Manhattan and Inwood. It's great. It's terrific. We love it. You walk through, there's all musicians.
Now we had the resurgence in Harlem, and then we had a decline. Any idea? What's your thoughts about Harlem?
I mean, we own a lot of buildings up there, and I actually really like the neighborhoods. I think it's picked up a lot over the last, 6 to 9 months, and we're actively looking at new, property up there. I think the whole Columbia expansion has changed dramatically the makeup of what's going on the west side, in the 130s, 140s, and it's pushing more north. And it used to be very, very street and block specific, and I'm seeing much more of a sort of follow through from that. And the retail, I think, is picking up. The type of retailers, that's the other area I really think is interesting now, is I think retail is sort of coming back, and even in prime locations in Manhattan, I think you're seeing rents that are big rents now again.
I mean, urban retail, Manhattan, New York City, the 5 boroughs are under retail. So urban retail is doing very well, and, it's been definitely there. So it's an interesting market. You in the market and lending in the Bronx and so on?
Oh, the Bronx has always been one of our markets. When a lot of the lenders weren't, we were there.
Okay. So I think my viewers and I have got a pretty good idea of how you people look at the market. I'd like to thank Martin, Barry, Ben, and my friend Mr. Please, I don't know Mr. Adams. And if you want, you can catch this on iTunes and a variety of places or in the Stoller Report app. See you next week.